deeper into Ackman's unique strategies, let's establish a foundational understanding. What exactly is a hedge fund? At its core, a hedge fund is an investment partnership that employs advanced, often complex, strategies to generate returns for its clients. Unlike traditional mutual funds, hedge funds have fewer restrictions and can invest in a wider range of assets, often using techniques like short selling, leverage, and derivatives. These tools allow them to hedge against market risks, aiming for positive returns regardless of market direction. William Ackman's path to becoming a financial titan began with a solid academic foundation, earning his bachelor's degree from Harvard College and an MBA from Harvard Business School. In 1992, at just 26 years old, he co-founded his first investment firm, Gotham Partners. This early venture focused on smaller, public companies, often engaging in some form of shareholder activism. It was during this period that Ackman began to hone his analytical skills and develop the bold, research-intensive approach that would later define his career at Pershing Square. After an impactful, though sometimes contentious, tenure at Gotham Partners, Ackman launched Pershing Square Capital Management in 2004 with a substantial amount of capital. The name Pershing Square itself evokes images of robust, open public spaces, perhaps symbolizing the transparency and directness he aimed to bring to his investment approach. From its inception, Pershing Square was designed to be an activist hedge fund, focusing on a highly concentrated portfolio of public companies where Ackman believed he could unlock significant value through strategic intervention and governance changes. Now, let's define activist investing, a cornerstone of Ackman's strategy. An activist investor is a shareholder who buys a significant stake in a public company with the intention of influencing its management or strategic direction. They aren't passive investors, they seek to implement changes they believe will enhance shareholder value. This can involve advocating for new leadership, pushing for divestitures, improving operational efficiency, or even proposing mergers and acquisitions. It's about taking an active role to unlock potential. Ackman's success is often attributed to his unwavering conviction. Once he identifies a company he believes is undervalued and ripe for change, he commits fully. This isn't just about financial commitment, but also intellectual and reputational. He invests heavily in research, often spending months, even years, analyzing a target company. This deep due diligence provides the foundation for his confidence, allowing him to stand firm even when facing significant opposition or market skepticism. It's a testament to thorough preparation and belief in one's own analysis. A hallmark of Pershing Square's strategy is its highly concentrated portfolio. Unlike many hedge funds that hold dozens or even hundreds of different stocks, Ackman typically invests in a small number of companies, often fewer than 10. This approach reflects his high conviction in each selected investment. By focusing on a few key positions, he can dedicate extensive resources to understanding each company deeply and actively engaging with management. This concentration means each investment carries significant weight, amplifying both potential gains and losses. Ackman's investment process begins with exhaustive research. It's not simply about glancing at quarterly reports, it's a deep dive into every aspect of a company. His team scrutinizes financial statements, analyzes industry trends, evaluates competitive landscapes, and even conducts extensive interviews with former employees, customers, and suppliers. The goal is to develop an owner's mindset, understanding the business as if they were going to acquire the entire entity. This meticulous approach ensures that when Pershing Square takes a position, it's based on a profound understanding of intrinsic value. Central to Ackman's research is the concept of intrinsic value. This isn't just the current market price of a stock, but rather the true, underlying value of a company's assets, earnings, and future cash flows, independent of how the market is currently pricing it. Think of it like appraising a house. Its market price might fluctuate based on demand, but its intrinsic value is determined by its land, construction, location, and potential rental income. Ackman seeks companies whose market price is significantly below their calculated intrinsic value, representing a clear opportunity for growth once changes are implemented. When a company's management is resistant to change, activist investors like Ackman may engage in a proxy fight. This is a formal process where shareholders, unhappy with current leadership, try to convince other shareholders to vote for new directors or propose changes at the annual meeting. It's essentially a battle for control of the company's board. Pershing Square often prepares detailed presentations and public letters, outlining their case and vision for the company. These fights can be lengthy and public, demanding significant resources and strong communication skills. One of Ackman's early high-profile activist campaigns involved Target Corporation. In 2007, Pershing Square accumulated a large stake and proposed spinning off Target's real estate assets into a separate REIT, or Real Estate Investment Trust. The idea was that Target's vast property holdings were undervalued on its balance sheet, and a separate entity would unlock that value for shareholders. While the full spin-off didn't happen as proposed, Ackman's engagement brought significant attention to the company's asset base, demonstrating his ability to identify hidden value and challenge conventional corporate structures. Not all of Ackman's campaigns have yielded positive results. A notable example is his investment in JCPenney. Believing the struggling retailer had significant turnaround potential, Pershing Square took a substantial stake in 2010. Ackman became a board member and played a key role in bringing in a new CEO, Ron Johnson, from Apple, to revolutionize the brand. However, Johnson's radical changes alienated loyal customers, leading to massive sales declines. After years of losses, Ackman eventually exited his position in 2013, incurring significant financial losses and learning a valuable lesson about retail turnaround challenges. The JCPenney saga offers crucial insights into the risks of activist investing. It highlights that even with meticulous research and a strong vision, external factors, execution challenges, and customer behavior can derail the best-laid plans. It demonstrated that a company's culture and its existing customer base are powerful forces that cannot be easily or quickly changed. For Ackman, it was a public setback, yet one that undoubtedly refined his understanding of organizational change and market sensitivity, reinforcing the need for flexible strategies even with strong conviction. Beyond activist investing, William Ackman is also known for his high-profile short-selling campaigns. Short selling is an investment strategy where an investor profits from the decline in a stock's price. Here's how it works: an investor borrows shares of a stock they believe will fall, sells them immediately, and then buys them back later at a lower price to return to the lender. The difference between the selling price and the repurchase price is the profit. It's a high-risk, high-reward strategy because potential losses are theoretically unlimited if the stock price rises indefinitely. Perhaps Ackman's most famous, or infamous, short-selling bet was against Herbalife. In 2012, he publicly declared that the multi-level marketing company was a pyramid scheme, vowing to take his short position to the end of the earth. He presented a detailed, 3-hour public presentation outlining his thesis, predicting that the stock would eventually go to zero. This sparked a contentious, multi-year public battle with fellow hedge fund manager Carl Icahn, who took a long position in Herbalife. The conflict became a dramatic spectacle on Wall Street, showcasing the intensity of high-stakes financial combat. The Herbalife short was a grueling, public, and ultimately losing battle for Ackman. Despite his extensive research and persuasive arguments, Herbalife's stock price did not collapse as he predicted. Instead, it often rose, especially fueled by Icahn's counterbet and the company's buybacks. Ackman eventually closed his short position in 2018, reportedly costing Pershing Square hundreds of millions of dollars. This episode underscored the immense difficulty of successfully shorting a company, especially one with a resilient business model and powerful opponents, regardless of the perceived merits of the argument. The Herbalife experience taught Ackman, and indeed many in the financial world, several profound lessons. First, that market sentiment and powerful opposing forces can sometimes override fundamental analysis, at least in the short term. Second, that short selling, especially publicly, can be an extremely dangerous game, as it can attract counter-investors and become a referendum on the investor themselves. Finally, it highlighted the importance of position sizing and knowing when to concede, even when deeply convinced of a thesis. Humility, even for a maverick, is essential. Another significant, and ultimately troubled, investment for Pershing Square was in Valeant Pharmaceuticals. Ackman invested heavily in the pharmaceutical company, attracted by its strategy of acquiring other drug companies and then drastically raising prices on their acquired drugs. Pershing Square again took an activist stance, supporting Valeant's management and its aggressive acquisition strategy. For a time, the investment was highly successful, generating substantial paper gains. However, this period of prosperity proved to be fragile, setting the stage for future challenges. The Valeant investment turned sour due to intense scrutiny over its pricing practices, accounting irregularities, and a short seller report that raised serious questions about its business model. The company faced massive political and public backlash, leading to a dramatic collapse in its stock price. Ackman, caught in the spiraling decline, continued to support management for a period, even after immense losses. He eventually exited his position in 2017, incurring one of the largest losses in hedge fund history, further demonstrating the unpredictable nature of high-stakes investments and the power of public opinion. In a testament to his adaptability and keen market timing, Ackman executed a brilliant trade at the onset of the COVID-19 pandemic. In February 2020, sensing the impending economic fallout, Pershing Square placed a series of credit default swaps on corporate bonds. These are essentially insurance policies against companies defaulting on their debt. His timing was impeccable. As the pandemic hit and markets plunged, these hedges paid off handsomely. It was a contrarian bet that saw him publicly warn of the coming storm, demonstrating his ability to foresee systemic risks. As global markets plummeted in March 2020, Ackman's hedges generated a staggering profit of over $2.6 billion, effectively recouping previous losses and securing Pershing Square's strong performance for the year. What's more, with the proceeds from these hedges, he then reinvested in many of his core portfolio companies, taking advantage of their temporarily depressed valuations. This move demonstrated exceptional strategic foresight, protecting capital during a downturn and then deploying it opportunistically to capture the rebound. It was a masterclass in market navigation during extreme uncertainty. Beyond the dramatic swings of short selling and market timing, Ackman's core philosophy remains rooted in building better businesses. He believes that true, sustainable value is created when companies operate efficiently, have strong governance, and are aligned with shareholder interests. His activist campaigns, even the contentious ones, are driven by a desire to improve corporate performance and transparency. He sees himself not as a destroyer of companies, but as a catalyst for their long-term health and profitability, often pushing for simpler, more focused business models. In early 2022, Pershing Square took a significant stake in Netflix, seeing a compelling opportunity in the streaming giant after its stock had dipped. Ackman praised Netflix's subscription model, global reach, and strong content. However, just a few months later, after Netflix reported a subscriber loss and a significant further drop in its stock price, Ackman swiftly exited the position. This quick reversal, while painful, highlighted his evolving discipline, acknowledging mistakes and cutting losses quickly, rather than clinging to a thesis that was clearly undermined by new data. This shows growth from past experiences. The Netflix decision, though costly, demonstrated a crucial aspect of Ackman's evolution as an investor: discipline. Previously, with JCPenney and Valeant, he held on to losing positions for far too long, hoping for a turnaround that never materialized. The rapid exit from Netflix, despite his initial conviction, showed a greater willingness to admit when a thesis is broken and to protect capital. It's a hard but vital lesson for any investor, knowing when to cut your losses and preserve your remaining capital for better opportunities. What can we distill from William Ackman's career about the qualities that define a truly great investor? First and foremost, it's the ability to think independently and contrarian. He rarely follows the herd. Second, an insatiable curiosity and commitment to deep, thorough research are paramount. Third, the courage to act on conviction, even when it's unpopular. Fourth, resilience in the face of setbacks, learning from mistakes, and adapting strategies. These are traits that extend far beyond finance, applicable to any field requiring strategic thinking and decision-making. Despite the dramatic short-term movements his trades often generate, Ackman emphasizes a long-term view in his core activist investments. His goal isn't to flip a stock quickly, but to partner with companies to create enduring value over many years. This patient capital approach allows time for strategic changes to take root and for the market to eventually recognize the true intrinsic value. It's a powerful lesson for all investors: resist the urge for instant gratification and instead focus on fundamental business improvements that compound over time. In the world of finance, where trust is paramount, integrity plays a crucial role. Ackman, despite the controversies and public battles, has consistently emphasized the importance of transparency and ethical conduct. While his aggressive tactics might be polarizing, he often operates in the open, publicly articulating his theses and engaging in debates. This commitment to operating within a framework of principles, even when facing intense scrutiny, reinforces the idea that long-term success in finance is not just about making money, but also about how you make it and the reputation you build. Let's compare activist investing with a more common approach: passive investing. Passive investors typically buy index funds or ETFs and hold them for the long term, aiming to match market returns without trying to pick individual stocks or influence management. Activist investors, by contrast, are actively involved, seeking to beat the market by driving specific changes. Both have their merits. Passive investing offers diversification and lower fees, while activist investing, when successful, can generate outsized returns but comes with higher risk and requires specialized expertise. Effective communication is another vital skill Ackman demonstrates. Whether it's crafting detailed presentations for investors, writing public letters to management, or engaging in media interviews, his ability to articulate complex financial arguments clearly and persuasively is a significant asset. In activist campaigns, winning over other shareholders and shaping public perception can be just as crucial as the underlying financial analysis. His direct, often blunt, communication style ensures his message is heard, for better or worse, influencing the narrative around his investments. The landscape of activist investing continues to evolve. While once seen as aggressive corporate raiders, many activist investors are now viewed as valuable catalysts for change, particularly in areas like environmental, social, and governance, or ESG, initiatives. Shareholders are increasingly demanding accountability from companies, and activists can play a crucial role in pushing for these improvements. William Ackman's career trajectory reflects this evolution, showing how a determined investor can, through deep analysis and bold action, shape not just individual companies but also broader corporate practices. Imagine a day in the life of William Ackman. It's likely filled with intense analytical work, deep discussions with his team, calls with management teams of portfolio companies, and careful monitoring of global markets. There's a constant synthesis of vast amounts of information, always seeking that overlooked detail or market inefficiency. The pressure is immense, with billions of dollars at stake, and the public eye often fixed on his every move. Yet, it's this environment of high stakes and intellectual rigor that drives him and his team to continually seek out the next great investment idea. From Ackman's journey, we can extract several key investment principles applicable to anyone. First, invest in what you know and understand deeply. Avoid fads. Second, always prioritize fundamental value over short-term price movements. Third, be patient. Good investments often take time to mature. Fourth, be prepared to act decisively when opportunities arise, but also to admit when you're wrong and cut losses. Finally, and perhaps most importantly, continuously learn and adapt your strategies as market conditions and your own understanding evolve. This is an ongoing journey. Today, Pershing Square Capital Management continues to be a prominent force in the investment world. While Ackman has refined his approach over the years, becoming more selective with his public pronouncements and focusing on fewer, higher conviction bets, the core tenets of activist, value-oriented investing remain. The firm continues to seek out companies where it believes significant value can be unlocked, applying the rigorous research and engagement that have defined its founder's career. The legacy of William Ackman's unique blend of finance and activism is still being written. Beyond his financial pursuits, William Ackman is also a notable philanthropist. Through the Pershing Square Foundation, established with his former wife Karen Ackman, he has supported numerous initiatives in education, healthcare, social justice, and economic development. This commitment to giving back reflects a broader understanding of wealth's purpose. It demonstrates that the impact of a financier can extend beyond market returns, contributing to societal well-being and shaping a better future. It's a reminder that even the most aggressive investors often have a softer, humanitarian side. For anyone aspiring to understand finance and investing, Ackman's career offers invaluable lessons. Start by developing a deep understanding of business fundamentals. Read widely, question assumptions, and don't be afraid to form independent opinions. Embrace both success and failure as learning opportunities. Recognize that true wealth building is a long game, requiring patience, conviction, and constant adaptation. Most importantly, cultivate intellectual honesty, be rigorous in your analysis, and be humble enough to admit when you're wrong. These are the foundations of sound investment decisions. William Ackman's journey is a compelling narrative of ambition, intellectual rigor, dramatic successes, and public setbacks. He has fundamentally challenged corporate America, forced companies to reconsider their strategies, and highlighted the power of an engaged shareholder. His story is a testament to the idea that finance is not merely about numbers, but about people, ideas, conviction, and the relentless pursuit of value. By understanding his approach, we gain a deeper insight into the intricate mechanics of markets and the qualities required to thrive within them. Thank you for joining us on this exploration of William Ackman's world of finance and investing. We hope this deep dive into his strategies, successes, and challenges has provided you with valuable insights. If you found this video informative, please consider liking it and subscribing to our channel for more content that demystifies complex topics. Your engagement helps us continue to bring you in-depth analyses like this. Until next time, keep learning, keep questioning, and keep investing wisely.